All right, so today I wanted to make another quick video on a company that I think is very good, that I'd love to own, but is just too expensive. And this is Constellation Software. Again, they are a Canadian, obviously, software company. Again, they are up massively over the last year. They're up about 61%, which is just crazy. Over the 5 year, it's out of this world. Again, company's just growing extremely, extremely well. Again, they are obviously a software company, obviously, hence the name. Again, they do pay a dividend. They paid a dividend for a little while, but it is extremely small, only 0.15%. Again, free cash flow yield of 2.85%. Let's get right into it here. Let's look into them a little bit more. Again, analysts fairly bullish. Again, moderately bullish, I guess. Financial health definitely a little bit concerning, but again, this is a company that basically acquires companies. It's one of the main parts of their business. So take that for what you will. Again, they are growing extremely, extremely well. Not the greatest I've ever seen, but again, probably the top 10 percentile, 20 percentile for sure. Again, profitability, very, very good. Net margin, operating margin probably could use a little bit of work, but I mean, if you look at their cash conversion, extremely good. 98% gross margin, that's crazy good. Free cash flow margin, 20%, that's crazy good. Again, management is really where one of the other areas this company really shines. 29% return on invested capital is extremely good. 31% return on equity, also extremely good. Again, the valuation is the one area that is concerning, and this is the reason I don't own this company. Again, price to free cash flow 35, 5-year average 27, PE is 108. Again, so the company's clearly expensive. Again, if people are wondering, okay, well, how low would it need to go to buy it? Again, I would need to see probably like 25% below where it's currently at. So again, you would need to see a sizable pullback for me to get interested in this company. I mean, I'm interested in it, just not buying it yet. Again, if we look at that balance sheet, it's okay, but it definitely could be better. If we look at its metrics, this is in one of the areas this company really shines. Again, the free cash flow margin and operating cash flow margin, again, 2022 a little bit concerning, but again, historically this is a very, very profitable company, very, very good margins. Again, we look at that return on invested capital, extremely good. I mean, they've had numbers as high as 65%. I mean, that's just crazy good, right? So again, this is one of the main reasons I just very interested in this company. Again, if we look at the cash flow here, again, free cash flow, again, it has kind of topped off a little bit. I mean, the last few years or so, but again, it grew extremely well over the last decade. Is it going to grow that well going forward? Probably not. Again, if we look at its debt, it is taking on debt, which is something that is possibly a little bit concerning. But again, this is a company that acquires other companies, is basically the main part of their business. So taking on debt, if they're good acquisitions, then that's going to help them in the long run. They have not issued a share in over a decade, which is very nice to see. Again, if we look at the dividend, only 0.15%, and they've been paying that same dividend for $1 a quarter going back years, basically like a decade. So again, in my opinion, it'd be nice if they started raising that dividend, but it doesn't look like that's going to happen. Last thing here, let's check out the valuations. Again, basically a straight up arrow for the operating cash flow per share and free cash flow per share, which is very good to see. They've grown those both at about 20.5% per year, which is extremely good. Price to operating cash flow, again, the average 23.58, the latest 34.2. So again, they're definitely expensive. Let's go back 5 years just out of curiosity here. Again, the average 26.45, the latest. So again, they're still expensive. And not only that, people are starting to pay more. They're starting to pay more for existing levels of earnings, which is something that's definitely a little bit concerning. But actually, over the last 5 years, they're going faster than the last 10 years, which is good to see if you're looking to buy. So again, to sum it all up here, again, I think that this is a very good company, a very, very good company. Again, we just need to see a reasonable valuation before you would buy it. So again, we go back 5 years, the average price to operating cash flow is 26.45. If it got down to, let's say, 27 or below, that's where I would start to look it up. So again, you're looking at probably a 20% pullback, 20-25% pullback, or they would have to start growing earnings faster and people not pay a higher valuation. So again, I just wanted to make a quick video on this stock because, again, I think it's a very good stock. I think it's a very, very good stock, very underrated stock, and given it trades just on the TSX, I think it kind of goes overlooked a little bit. So anyway, that's what I wanted to bring up today. If you liked the video, hit that like and subscribe, and stay tuned for more.